Hey guys, John Paulamy here, Actionable Intelligence. Wanted to plug the new issue of Actionable Intelligence Alert. It comes out today, May 1st. But also I wanted to talk about a couple of other items that I focus on in the newsletter this month in a general sense. Obviously I can't get into the pick for this month, but I can talk about in a general sense what I'm writing about. I was recently reading some articles about some pension funds and pension situations in some of these blue states, if you will. And what they have is a situation where promises have been made over many, many decades to state employees, state government workers. And these are obviously left-leaning and Democratic-controlled states, so they have co-opted these unions and given them excellent pension benefits that the average private sector person doesn't get in exchange for their votes and support and contributions to their campaigns. So it's been a vicious cycle of buying votes and buying contributions. And now we're to the point now where we have a population of people that is going to expect a certain lifestyle in their retirement, and it looks like the various municipalities and state governments cannot deliver it. And if this happened in the private sector and you had a fiduciary responsibility and you were running like a annuity or a life insurance company or something where you were taking in money and telling people that you were going to give them a certain return or a certain payoff if a certain event happened, and you weren't able to do what you say you were going to do, that would be considered fraud. But as we're dealing with government, they can do whatever they want. The laws don't apply to them. But that's a whole nother video. The thing I wanted to get into was the fact that in a lot of these states, and I'll use Illinois as an example, there was an article about several smaller municipalities that are having to cut essential services like firefighters, sewer upkeep, road upkeep. One city called, I can't remember what it's called now. Anyways, Harvey, because it was like Hurricane Harvey was the name of the article. I'll post it in the links. But, I mean, the city services have collapsed because of the pension obligations that the city owes to the state employee pension fund that it simply can't pay. And the problem is in these states, especially a state like Illinois, is that if you can't pay something, that which can't be paid will not be paid. So what they're doing is taking away services from taxpayers to pay government employee pensions. And they can't declare bankruptcy or they can't do anything to get out from under this because the state laws there in the state do not allow for municipalities to declare bankruptcy. So they're trapped in this vicious cycle of increasing pension obligations that are very rich, that the typical private sector employee would never even see, and they can't pay it, and yet they can't continue to just tax. So something has to give. So they start cutting services because under the state laws, they have to make these contributions. So this is just a microcosm of what's going to happen over the next several decades here in the United States. I've written before, and I'll put a link to it on my blog, of a article I wrote about the unfunded Social Security and Medicare obligations that the federal government in the United States has. They're simply not payable. Whoever you want to listen to, they're anywhere between $100 and $200 trillion in unfunded liabilities. And the problem is that they can't be paid. So this is one of these things that kind of gets into the psychology I've talked about before. It's not something that's going to be an issue tomorrow or next week or even next month or maybe in the next couple of years. But if you read the article, you'll see that these obligations are consuming an ever greater amount of the federal budget. And in the article, I talk about 10,000 people every day going on Social Security and Medicare, and that's what we're going to see. The cohort of baby boomers is now moving into the stage where they're going to be drawing these benefits, and you're going to see 10,000 of these people go on Social Security and Medicare every single day for the next 20 years, 15 to 20 years. And it simply won't be able to be paid. Tack on to that the fact that we're already going to be running close to trillion-dollar deficits after this recent tax cut we've had, and some of the other things, the spending increases that the Congress and the President agreed to. And we're getting into a situation where this is going to, we're at 21 trillion, then we're at 30 trillion, then we're at $40 trillion in debt. And they're talking about interest rates going up. I mean, what scares me is the interest rates going up, and the fact that interest now is like the third largest expenditure. Interest on the debt is the third largest expenditure in the federal budget. So we're starting to get into this circling the drain black hole where you've crossed the event horizon and you can't get out of the black hole now. Now you're spinning around getting ready to descend in. So what I'm getting at is that this is a reason why I recommend that people, if you have some cash and if you have an investment plan going on, that you hold a certain amount of gold. And I go back to the Ray Dalio, who's a famous money manager and hedge fund manager. He was giving a speech at a investment conference, and somebody asked him, "What do you think of gold?" And he says, "Hey, I like gold. I have, I think he said he has like 15 or 20% of his assets in physical gold." And you heard all this snickering and laughing in the crowd. And he said, "Hey, if you don't own gold in your portfolio, that just means that you don't understand history or economics. The history of the world is governments spending more money than they take in to appease the population so that they can get the support of the populations, whether it's the votes or the favor or whatever." And we've seen it throughout history. We've seen that every empire is usually brought down by its excessive amount of debt. And we're not going to be any different. You can put an eagle on your shoulder, wrap an American flag around yourself, put a "Make America Great" hat on again. It's not going to change the dynamic. The debt is growing. The unfunded obligations are huge, and they cannot be paid. They will not be paid. So what will happen? In the article, I talk about what I think will happen. We've already started to see that. I think you're going to see higher taxes. You're going to see lower benefits. You're going to see debasement of the currency. So what am I talking about, debasement of the currency? Where the government just prints money to pay its debts. And we've seen in some of these banana republics like Venezuela or some of these other places where you see what happens when you do that. You can do that. That's taken to an extreme in those countries, and you have hyperinflation, and you have the currency lose value. People's wealth is dissipated and confiscated through the inflation by the government. That's what it basically does. It does it in a way, hopefully, that it can do it slowly so it's not noticed. You obviously notice it in these South American banana republics when you have an inflation rate of 10,000% a year like they have in Venezuela. I mean, it goes back to the old, how do you boil a frog? You don't take a live frog, and throw it in a pot of water that's boiling, he'll jump out. What you do is you place the frog in a cool pot of water and slowly turn the heat up on him, and he never knows. The heat builds at such a gradual rate that the frog never realizes it's being boiled alive. So that's the history of government and what they do. I mean, it goes without saying, every single paper currency since man has existed has failed. It's been inflated away. And people don't understand that even in the United States, the dollar, we're on I think the third or fourth iteration of the dollar. I mean, the first paper currency that was issued by the U.S. government was back during the Revolutionary War, and it was called a continental. And they used to have a saying back in those days, it's not worth a continental. That was a derogatory statement against that particular form of currency. So what I'm getting at, guys, is that you have to be educated and cognizant of these things. And like I said, I'll put a link to that article. And so I like gold. I like physical gold, but I also like to invest in mining. It has the ability, if it's done correctly and at the right time, and the timing's right, to generate tremendous amounts of wealth. Now, again, as I've said before, mining is not a great business. Mining is a 19th century choo-choo train industry, as Doug Casey says, that everybody perceives as unnecessary, dirty, polluting, and only lowbrow people work in it and advocate for it. But in reality, mining, everything that we have in our house, everything that we have in our business, every product is either the result, the inputs into it are either grown by farmers or mined by miners. That's just the way it is. And that's why I have an interest in it. That's why I think it's a unique investment area. And like I said, I like gold long term, but I also want people to understand that gold is not very popular for long term holding because it generates no return. It's not like a house that generates rents or a stock that pays dividends. But there are certain companies in the gold mining industry that I think meet a couple of needs. And what I'm talking about are royalty companies, gold mining royalty companies. And one of my favorite companies of all time, and one of my favorite investors and virtual mentors, if you will, is a guy called Pierre Lassonde. And Pierre Lassonde, along with a guy, I believe the guy's name was Seymour, I can't remember the guy's name, but he recently died. They were the founders of probably the biggest and best managed royalty company, gold mining royalty company of all time. And the name of that company is called Franco-Nevada. Now, Franco-Nevada is a very large, multi-billion-dollar company. It trades on the New York Stock Exchange. And I think if you look at the history of that company, I think it was started in the early 80s. It's grown tens of thousands of percent. It would be kind of like a 100-to-1 shot, like we were talking about with Thomas Phelps' book, 100-to-1 in the stock market. If you look at the history of that stock and history of that company, it's grown all through all the different cycles of gold. It's continued to have an excellent return for shareholders. And the reason that is because in the mining business, mining minerals or gold, for example, is a very tough business. You have to spend a tremendous amount of time and effort finding a resource that is actually economic. You then have to go through the process of permitting that mine, going through all the nonsense with the governments and the NGOs and the First Nations tribes and all the other things you have to go through to get a mine permitted. Once you get the mine permitted, then you have to get it financed. You have to actually build the mine, and then you actually begin mining, which is hit or miss many times because at every one of these steps, something can go wrong. And it's typically a long lead, long time frame to bring a mine from discovery to where it's actually producing. It could be up to 10 years. We've talked about this before. So the metal price when you conceive this mine or when you started to build it could have been very high and the economics made sense, but by the time you get it built, you could be at the bottom of the cycle and it's not as economic. So that's what makes the mining business very tough and not really a great industry for return on capital. But in the royalty business, we have a different dynamic. What we're saying is we have capital that we are going to give to a royalty company or loan it to them, I guess you would say, or give them capital. And in return, they are going to give us an overriding royalty on the metal they produce. So it might be something like a 2 or 3% royalty on the gold that they produce. So every ounce of gold that they sell, we get 3% off the top. So if I'm running a company like Franco-Nevada, I only need, what do I need? I need, a management team, a business development guy, a couple of lawyers, and a couple of geologists to make sure that that I'm getting involved with a mining company that has a legitimate ore body. And you're talking about 20 or 30 people max, or maybe even less if you get a smaller royalty company. You maybe consult out a lot of this stuff. So you might have a half dozen people working there. And you have no, in addition to that, you have no mining risk. We're not out there, a royalty company is not actually out there mining it. It's not going through the permitting. It's not dealing with labor issues, trying to get equipment to the mine, fuel, making sure that the helicopters are bringing the crew, all the crap that you got to go through on a daily basis to run a mine. All we're doing is saying, you produced 10,000 ounces last quarter, send me a check for my 2% or 3%, ad infinitum. And that's the basis of the royalty business. It's very high margin business. Some of the margins I've seen on some of these royalty companies like Franco-Nevada, Royal Gold, Silver Wheaton when it was around, some of these smaller royalty companies, they're in the 80 to 90% range. So for every dollar in revenue you're getting an operating margin of 90 cents, 80 cents. That's tremendous. So further to that, when you're in the royalty business, as long as the mine's producing, we don't really care if the miner makes money. We would prefer they do because we want them to stay in business and continue to mine. But if their margin is only 5 or 10%, it really doesn't matter if the price goes from 1,200 to 1,100 or to 1,300. It doesn't make that much difference to us on our margins as a royalty company. So it's a tremendous business. And the other thing I like about the business, and something that Pierre Lassonde said many times and stuck in my mind, is that when you sign a royalty on a mine, let's say they have their footprint of the mine is several hundred acres, but they have the ability to explore on additional acres around the mine. What typically happens with the royalty company is they'll say, I'm going to give you this money. I want a 2% royalty on this mine that you're developing, but I also want the ability to have a royalty on anything that you find around this mine. And why is that? Because the best place to find gold, oil, nickel, uranium is right next to a gold, oil, or nickel mine. That goes without saying. So what you have then is you have optionality. Not only are you getting the day-to-day, week-to-week, month-to-month revenue from that producing mine, but if they decide, if the mining company that's running the mine decides to expand or look for additional resources on the land that they control around their existing mine, you have the ability to get a royalty on that also, and that's called optionality. And one of the things that stuck in my mind with Pierre Lassonde was you're basically operating on other people's money. They're paying for all the drilling, they're paying for all the geologists. You're just sitting back and saying, okay, if you find something, then I get an additional royalty on it. And that's called optionality. And one of the things that he said was, many times I've heard him say, you know, Franco-Nevada, we have all these royalties and we have, you know, millions of acres of potential optionality. And if you have a million or a million and a half acres out there that you have option on, at some point you just get lucky. And what he's saying is, you know, this is a numbers game. And the more acres are out there, the more chance there is that something will be found on some of those acres that can be converted into an additional royalty. So that's kind of a quick rundown. I go into it more in depth in this month's issue about how royalty companies and streaming companies work. I think they're tremendous businesses. They're high margin businesses. And what I like about gold royalty companies is it gives us a twofer. We get the protection and insurance of gold, which I think is going to be more important as the years go by and as the financial condition of the United States deteriorates, as the debts increase, as the obligations increase. I believe that's going to lead to more dollar debasement, and that's going to lead to a higher gold price. We get that protection, that insurance, but we also get that optionality and that growing business sense if we get into the right gold streaming or gold mining company or gold royalty company. So the focus of this month's newsletter pick was a very, very junior, small gold royalty company. The company is one of the few companies on the venture exchange. I believe it might be the only venture exchange company that actually pays a dividend. The dividend is growing. The management has committed to growing the dividend. They're doing that. They're out aggressively looking for smaller royalties. They try to play in a smaller area, so they're not competing against the big money guys like Franco-Nevada, Royal Gold. They're concentrating in the smaller mining mines and playing in a smaller pond, and that doesn't attract the attention of the bigger royalty companies. They just don't want to waste their time down in these lower tier smaller mines that aren't going to really affect their top or bottom line. So it's a niche business. Currently, you know, I'm long-term bullish on gold. I like royalty businesses, especially in the gold mining industry. They're high margin, like I said, and I also think the gold price is going higher over the next 5 to 10 years. And I think it's an excellent company. It's going to be a growth company, and the company's staffed with a lot of people that have experience in this business. They're former mining executives or current serving mining executives or board members on successful other mining companies, and I think it's an excellent company to take a look at. But you'd have to get the newsletter, and I encourage you to subscribe to the newsletter, actionableintelligencealert.com/subscribe. Put a link to it in the show notes. So that's just a quick synopsis of why I like gold long term. I just think that the Western countries are bankrupt, functionally bankrupt. They have very old populations that are counting on these pension and healthcare benefits that simply will not be able to be paid. And I think that if the historical narrative of the past is going to play out, which I believe it will, I don't believe that these governments are going to renege on these obligations. They're not just going to outright say we're not going to pay them. What they will do is attempt to pay them first by taxing the productive class, and then they'll have no choice but to resort to what all governments have done in the past when they can't pay their bills, and that's just print money. And that's excellent for gold long term. So that's the video for today. I appreciate this, the support. You guys, subscribers, people continue to subscribe. Some people, if you want to do me a favor, if you want to help me out, subscribe to the newsletter, or just do something simple like share these videos with your friends or other people that may be interested. So that's it for this video and my midweek update, if it will. We'll thank you for the support, and we'll talk to you next time. Thank you.